The noose is tightening around SAC Capital, one of Wall Street's biggest trading firms. U.S. regulators have filed a civil case against the company, accusing it of insider trading. The FBI has also filed criminal charges against the hedge fund. Karina Huber has the details.
Federal prosecutors have charged top hedge fund SAC Capital advisors with running an insider trader scheme. The firm is accused of taking in hundreds of millions of dollars in illicit gains over a span of 11 years, beginning in 1999. Gains, prosecutors say, were made on trades in companies like Yahoo, 3Com, and others based on non-public information. In the 41-page indictment, prosecutors say unlawful conduct by individual employees and an institutional indifference to that unlawful conduct resulted in insider trading that was substantial, pervasive, and on a scale without known precedent in the hedge fund industry. Preet Bharara is the prosecutor leading the charge.
SAC became, over time, a veritable magnet for market cheaters. The SAC companies operated a compliance system that appeared to talk the talk, but almost never walk the walk. And that is why today the institution itself, rather than just individuals, stands charged with wire and securities fraud.
Columbia law professor John Coffey says charging a company is a particularly aggressive stance that the government has shied away from because of the impact it can have on the economy in terms of job losses. But he says this case is unique.
That's not the case with SAC, which is owned by one person, Stephen Cohen. There's very little risk of job loss, and there are no widows and orphans and innocent bystanders here. So it's the perfect case to return to what was our former policy of indicting corporate entities when their agents committed crimes.
While Cohen has not been charged because prosecutors haven't found evidence linking him to illicit trades, he stands to lose a substantial amount of money and could witness the downfall of his hedge fund. The indictment seeks to recoup the money gained from the trades in question. And since the investigations began, large investors like Citigroup have pulled out about $5 billion from the fund. Coffey thinks things could get much worse for SAC Capital.
None of these institutional investors want to be looking as if they are hand in glove with someone the government says is a crook. There is an importance to reputation, and it's very important here.
SAC, which has roughly 1,000 employees globally, says it has done nothing wrong and it has employed an arsenal of lawyers to fight the charges. Karina Huber, CCTV, New York.
And joining us now with more on SAC saga, its indictment, is James Copland, director of the Manhattan Institute's Center for Legal Policy. Thank you so much for joining us, Mr. Copland. Let's get straight into it. Prosecutors said the fund was involved in systematic insider trading, and that allowed it to make hundreds of millions of dollars in illegal profits, and that the alleged crimes date back to 1999 and continue at least until 2010. Why are they only filing the charges now?
Well, these things take time. Anyone who looks at a corporate criminal investigation realizes it takes a long time to bring charges, and that's going to be particularly true for something like insider trading. Insider trading isn't an easy thing to prove. If you read the indictment here, there's a lot of specifics there, and these things have to be developed with wiretaps and looking at emails and instant messaging and all this sort of thing. So the prosecutors or the FBI, the folks working together, have to get probable cause, they have to get warrants, they have to get taps, and ultimately, when you look at how prosecutions are done, they want to try to go after the bigger fish. What we've seen here is a series of individual indictments and 4 guilty pleas, and those really form the predicate for going after the institution. I agree with Professor Coffey, it's not typical to file charges against the institution because of the risk of collateral damage.
Right.
And
like we saw with that Arthur Andersen, right?
Now, Arthur Andersen, it brought the accountancy down. I agree with the professor that in this case, while there are 1,000 employees and there is a substantial amount of capital outside Steve Cohen's personal holdings here, the collateral damage is somewhat more limited, although it's not 100%.
Now, James, you mentioned the bigger fish, and the big fish in this bigger fish seems to have escaped this. The criminal charges come a week after the SEC filed civil charges against the founder, Steve Cohen, accusing him of failing to prevent insider trading, but he's avoided personal criminal charges. How come he hasn't been charged, and do you think he will be charged in the future?
Well, I mean, I think the key point is to say yet. If you read the indictment, there's a lot of language with direct communications from what the indictment calls the SAC owner, which is obviously Steve Cohen. And so then the question is, are they going to be able to form a criminal sort of case saying that he actually knew he was playing on insider information? It's generally much harder to build a case on the boss of employees that are working in insider information than it is on the institution itself. You basically...
And hey, as he said, he was in the Hamptons when all of this went down, at his pool in the Hamptons. Now, so what are the implications for Steve Cohen and for SAC with this criminal fraud charge?
Well, I mean, I think the implications are very serious. It's not clear that even though there's an indictment, it's not clear that they'll end up going to trial here. Often what you see in these sorts of cases is what's called a deferred prosecution agreement, where the organization agrees to certain changes, to paying penalties, to admitting certain things, and then they decide not to go forward and push to a trial with the company, which would really bring a company like this down. I mean, clearly what they're looking for, if you look at the civil case against Mr. Cohen that they have initiated, they're looking to basically get him out of the financial markets entirely, which would be quite a move, but it might be something that would sort of be bargained, where he could avoid criminal prosecution, disgorge certain amounts of profits, and then basically get out of the business, and to some degree...
Now, James, how prevalent is insider trading? At what point is information illegal, as opposed to fund managers or analysts just doing their research and due diligence? And I want to play devil's advocate a little bit here. I mean, shouldn't people whose full-time job it is to learn more about their companies and their activities, and who spend considerable time and money with management of firms, be privy to reap the rewards of their research?
Well, absolutely, and that's the difficulty with what's almost a crusade by the Southern District of New York and the Justice Department on this type of insider trading list. I mean, on the one hand, you don't want individuals out there basically stealing company secrets and selling them off. So the prosecution of Rajarathan, who was getting on the phone with former McKinsey head Rajat Gupta, who was a board member of Goldman Sachs, and getting tipped off out of the board meeting. I mean, clearly there's an interest in deterring that sort of behavior. But that being said, I mean, when you read the indictment here, a lot of the allegations are, well, they were trying to recruit people who had a lot of contacts with companies in the industries. Well, of course they were. I mean, who else is going to be able to make better assessments there? And some of this is speculative. Now, some of it, I think, is actually pretty strong, where you're talking with doctors who have what looks to be inside information on actual clinical trials from drugs with the FDA and things like that. And that would, I think, be sort of a classic example of insider trading. So it becomes murky and ambiguous, but it is fairly difficult to prove. I mean, when you think back to Martha Stewart and her big trial, although there was pretty good evidence there, she was not ultimately sent to jail on insider trading, but rather obstruction of justice charges.
Okay, it is a murky case to prove, and certainly one we'll be following. Thank you so much. We'll have to leave it there. James Copland, Director of the Manhattan Institute Center for Legal Policy.